This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 15 of Value Investing. In this episode, I'm going to go over different approaches to assess companies' intrinsic value. This is very important concept because if you're a value investor, you want to assess companies' intrinsic value first, and you have to go through this exercise. And you want to buy a portion of ownership in the stock market when the stock price is a lot lower than your intrinsic value assessment. So that's the bottom line of how you do the value investing. And in order for you to do this one in a wise and accurate manner, you need to understand what kind of approach is out there when it comes to evaluating companies' intrinsic value. But it's easier said than done. I would say that it requires 50% of your left brain and also 50% of right brain, 50% of art and 50% of science. It's not just one single formula that you can use in order to assess companies' intrinsic value. You have to sometimes be creative, and sometimes you have to think about a range of different possibilities in order to have this intrinsic value calculation done in the right manner. Let me explain to you what I'm going to do in this episode and in the next episode. In this episode, I'm going to talk about 3 different valuation approaches. The first approach is called ratio-based approach. Second, asset-based approach. And finally, acquisition valuation. I think these are enough topic to talk about in one episode, and I'm going to talk about various things related to these 3 different approaches. And in the next episode, I'm going to talk about another very important intrinsic valuation methodology, which is discounted cash flow analysis. And I think that it's going to take some time for me to explain the detail about this discounted cash flow analysis, so I decided to push that topic to the next episode. However, it's important for you as an investor to know all these different approaches and try to apply that in your investment strategy. And if you have taken your MBA course or finance course, you probably have learned these 3 different approaches while you're at school. I'm going to go over how you can do that first, but I'm going to also have open discussion about pros and cons of these different approaches and how you can make your successful investment as a value investor by knowing these 3 different approaches and how you can apply them. Before I get into the details, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. Without any delay, let's get started. The first valuation approach that I want to talk about here is called ratio-based approach. So there are a lot of multiples out there. You can take a look. If you go to Google Finance, Yahoo Finance, and Bloomberg Terminal, there are just so many different outlets and places that you can go to in order to see a bunch of ratios. I want to emphasize 2 ratios here. The first one is price to earning ratio, and the other one is price to cash flow ratios. They are trying to capture essentially the same thing, but I think these 2 ratios are important in order to calculate intrinsic value of the company. And there are many benefits of using this ratio approach versus other valuation approach. When it comes to price to earning ratio, in the numerator, you look at the stock price, and in the denominator, you look at 1 year earning per share of the stock. So when you see a company selling a P ratio of 10, what it means essentially is it takes about 10 years for you to pay back and get back your original investment amount. That's how I interpret this P ratio, or price to cash flows ratio. And of course, you have to think about growth and you have to think about time value of the money. But my rule of thumb always when I look at these two ratios is to see how many years does it take for me to get my original investment back. Of course, the lower the better for value investors. And the reason I want to talk about this ratio-based approach first is because it's easy to get. It doesn't require any effort from your side in order to calculate this ratio because these numbers are readily available anywhere at your fingertips. If you go to Yahoo Finance, you'll find a bunch of ratio. If you go to Morningstar, you'll be able to find a bunch of ratios for you to look at. So it doesn't really require any effort on your side in order to get these ratios. This ratio approach is a good starting point always when you are trying to find out undervalued companies within certain industry. So let me go over some pros and cons of this approach so that you have some better understanding of how you can apply this approach for your investment strategy. As far as pros are concerned, these ratios are easy to get, as I mentioned, anywhere. So you don't really need to build your Excel model in order to calculate intrinsic value. You can get it right at your fingertips and it doesn't require any energy. The second benefit is that it is good for comparison across different companies in the same industry. Because the ratio is readily available, you can take a look at the ratio of different companies in the same industry and see which company is relatively overvalued and undervalued. All else being equal, if the ratio is high for a certain company, that means it is relatively overvalued compared to its peers in the same industry. And another benefit of using the ratio is that it does not involve any forecast on your part. So there's no subjectivity involved when it comes to evaluating a company's intrinsic value. Because I'm going to talk about later discount cash flow approach where it requires a lot of assumptions and a lot of subjectivity on your side. But here, the ratios are set and it's purely based on numbers that are already public. So there's not a lot of subjectivity involved. But one thing I want to point out here is that you might have to make some adjustments. So in that sense, it requires some subjectivity. So let me tell you what I mean by that. When you use P ratio or price to cash flow ratio, what you have to do is instead of just purely looking at accounting number, you have to make some adjustments. In one of the previous episodes, I talked about owner earnings, where I had to make adjustments to the earnings on the income statement in order to normalize for unexpected expenses or unexpected items. So for example, I'm recording this podcast in 2018. Last year, 2017, has experienced a lot of tax law changes. So in many cases, the company's reported earnings are not representative of normal earnings that they earn during the year. So you have to make that adjustments. Otherwise, you're going to use inflated earnings or deflated earnings compared to true normal earning. So make sure that you do that calculation before you apply this ratio. Instead of purely bring their earning from accounting income statement or from cash flow statement, you have to make the adjustments in order to use their earnings or cash flows that are more representative during normal economic time. So those are the things that you can benefit from using ratio-based approach. So let me go over some of the cons that are related to race-based approach. I briefly mentioned this one, but the first thing is you don't take into account growth of the company. If you purely look at the ratio, it's basically comparing price against 1 year normalized earning or 1 year normalized cash flow. you don't look at the future growth aspect. You don't take into account future growth aspect of your earnings or cash flow. If you're trying to calculate and assess intrinsic value of the company, and if you don't take into account growth, then it might be a little bit misleading. You might have some company with P ratio of 20, and if you want to compare that against another company with P ratio of 10, you might think that this is overvalued company. However, if the growth of the company in terms of revenue and earnings and cash flow is very high, then the P ratio is not applicable in this case. You cannot compare apple to apple because one company is fast growing company and the other one is mature company. The second disadvantage of using this approach is the fact that it doesn't take into account opportunity cost. So opportunity cost can be baked into the calculation when you do discounted cash flow analysis, but that's not the case here for race-based approach. But by design, this is a very simple approach and we don't take into account time value of the money and things like that. So that's actually the benefit and also disadvantage of using this approach. And finally, I also briefly touch upon this point, but you have to make adjustments to earnings and cash flow in order to have the right number for your investment calculation. So these are the pros and cons with respect to ratio-based approach. The second valuation approach that I want to discuss in this episode is called asset-based approach. This is going to be particularly useful if you buy a company, hypothetically, that is about to get into liquidation. So what it's trying to assess is that when company goes into liquidation and tries to sell all of its assets right now in the market, how much value can you get as an equity investor? So that's the question that we are trying to answer. So as a value investor, what you can do is to go to company's balance sheet. So that's what's important here. And go to the asset side of the balance sheet and try to understand how much value it's there. So you can go from top to bottom, and usually at the top you see cash and cash equivalents, and you don't have to make any adjustments there because it's a pure cash sitting in company's bank account. But if you go down to the list on the asset side of balance sheet, then you'll see a lot of variation in terms of the number on the balance sheet versus actual value of that asset. For example, if you look at inventory dollar numbers on the balance sheet, it's going to vary quite significantly across different companies. If you look at Apple stock and Apple balance sheet, what you see as part of inventory item is probably not going to worth much after 5 years. Because a lot of inventory that Apple has right now are cell phones, and these cell phones depreciate over time quite quickly. So the value that you can extract out of this inventory is going to be very small if you're trying to sell these assets to other people in a very short period of time. However, if you look at also some real estate, a lot of companies purchase their real estates and lands a long time ago, and they booked this real estate at original cost. So if you can make the adjustments, and if the current market value of that real estate is very high relative to what's written on the balance sheet, then you have to make upward adjustments in order to truly derive right intrinsic value. So one example that I want to give here is that Macy's has a huge mall right in the middle of Manhattan, and the true real estate value was not reflected on the balance sheet. So that actually drew a lot of value investors to Macy's stocks, and I was one of them, and I purchased a lot of shares when total market valuation was about $8 billion. But now it has gone up quite significantly in value. But back then, even just one real estate in the Manhattan was estimated to be valued at $4 billion. So half of the company's total market valuation. So that alone can provide a huge margin of safety for a value investor if you do your homework carefully and try to understand real value of company's asset. So once you have the assessment of this valuation, then you have to subtract liability, and you can also mark up and down liability items in order to get the true equity value of the company. So I explain in a simple terms here, but obviously it requires a lot of time for you to do the investigation. And if you don't have a lot of knowledge in this area, for example, if you don't know how to evaluate real estate, it's not going to give you edge over other investors. So this is a unique valuation approach that you can think about when you are trying to assess companies' intrinsic value. Also here, there are some of the disadvantages of using this asset value approach, because what you're trying to value is the asset value at the time of your stock purchase. So the company can make tons of more value out of the assets that they have. If that's the case, the asset value, the current market value of these assets might not really tell you about intrinsic value of the company, because intrinsic value should be assessed based on forward-looking numbers. So that's one disadvantage. Another disadvantage is that there are a lot of off-balance sheet items. So for example, Google has huge brand value, Apple, Microsoft, all of these brand values have been created through marketing expenses and also outstanding brand management over decades. But the problem that you're going to have when it comes to assessing brand value is that this is intangible asset. It's really hard to pinpoint exact value of the brand. However, this is true value to customers and clients. So if you have really nice brand, the customers and clients will trust you more than your competitors and will bring you more revenue and more business to your company. It's important to assess these intangible assets in order to understand how much asset value you have for a specific company. The third valuation approach that I want to discuss in this episode is called acquisition valuation approach. So what it tries to do is trying to assess how much value this company is to its competitors. So this is going to be very useful valuation if the company is in a competitive industry and the company is small and has some good, maybe for example, good technology that other big players want. So there will be many different ways the other big companies are trying to target small companies in order to expand their business or in order to get rid of the potential competitors in the future. Nowadays, there's so much money available at very, very low cost. The companies are trying to consolidate with each other and trying to strengthen their position in the industry in many ways. And one way they can do is through acquisitions. The value can be created when it comes to acquisition and merger if there's operational synergy between two companies. The big company can acquire a small company and cutting down expenses through consolidated back office functions such as IT, HR, risk management, and etc. And also, big companies can enhance their monopoly power in the market by buying small companies. And as I mentioned, that one also reason why the company wants to buy small companies is for strategic reasons. They are willing to pay very high premium for the technology that small companies has. For example, if a small company develop artificial intelligence technology that other companies do not have, then big companies would love to have this technology first in order to get some competitive advantage in the industry. Also, small companies could have some patents. So there are just a number of reasons why companies are willing to pay high premium on small companies' stock price in order to acquire the entire business. The recent example of this case is that Disney and Comcast are competing with each other in order to acquire Fox assets. So media companies are trying to consolidate into big one in order to compete with Netflix, and they're doing all the things they could in order to buy other media assets because contents are king in the media space. At the time of this podcast episode, Disney is trying to buy Fox assets, and Comcast is also are trying to do the same thing, and they are bidding up the price of Fox assets. So it's good news for Fox investors because the stock price has gone up quite significantly since the battle between Disney and Comcast. So this is another valuation approach that you can take a look, but my recommendation is that don't try to use this approach as your main valuation approach. The reason is that there's so much speculation here and everything is subjective. And you never know until the announcement is made whether the big companies will buy small companies, and you cannot really act on it based on rumor. So that's more speculation than investing. So I would say that this is just a good add-on for your investing approach and investing strategy, but don't rely too much on this acquisition valuation approach. Okay, that's it for today's episode. In this episode, we've discussed 3 different valuation approaches. First, ratio-based approach, where I discussed why this is very simple to use, and this is probably a good starting point for you to find out on the value securities in the market. And second, we talked about asset-based approach, where you can take a look at balance sheet and see if other investors are missing a big asset value in the company. And lastly, I talked about acquisition value, and here I gave some warning not to rely too much on this valuation approach, but it's a good add-on to your intrinsic value. Before I end, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. And if you want to leave your comments or any feedback to this podcast, you can always do so by going to valueinvesting.blueberry.net. Thank you very much, and see you next time.